Hello, Mr. Evans here with a video on analysing profitability. So we are here, how to analyse profitability, and we'll look at these different ratios in the next couple of videos. So first of all, this is a very simple income statement. Now, an income statement is a financial document. It used to be called a profit and loss account, but it's called an income statement these days. And what it does is it tracks all a business's revenues and all a business's costs over a period of time, usually 1 year. And we know that if we know total revenue and we subtract total cost from total revenue, that gives us our profit, and that's exactly what the income statement does. It tells us how much profit a business has made for a year. So just to quickly talk through how to read an income statement, normally you would get it in just one colour text, but I have put the costs in red so that they're easier to see. So at the top of the income statement, we find out how much money we earned from sales in the year, our total revenue, 950,000 in this case. Next, we subtract our variable costs, so the cost of raw material, the cost of packaging, delivery costs, any other costs that are related to producing each unit of output. In this case, the business had just over $500,000, which left it with gross profit of 400,000, calculated, of course, by subtracting the expenses from the total revenue. So the gross profit is simply total revenue minus variable costs, or total revenue minus expenses. Once we've got our gross profit, we still need, of course, to take away our fixed costs, our sometimes called overheads. So this business had £300,000 worth of overheads. Take that from our fixed costs, that gives us an operating profit of 100,000. Often called net profit as well. Operating on net profit means the same thing. If you see net profit, it simply means operating profit. Once we've got our operating profit, in this case £100,000, we then deduct taxes, interest payments, any one-off items that may have accrued over the course of the year, like buying or selling an asset. In this case, it was a cost of 25,000, and that left us with 75,000 profit for the year. That is the money we can either reinvest in the business or take out of the business and give to shareholders. So, just have a quick look at these two businesses and have a look at which one is more profitable. So at first glance, it appears that business A is far more profitable. It earns more revenue, it takes in more gross profit, more operating profit, and more profit from the year. So on the face of it, it may well look like business A is far more profitable, and in terms of raw numbers, business A is in fact, if we're looking at the operating profit, which is often the main form of profit that we look at, the business A is twice as profitable as business B. So we need to define a couple of terms. There's a difference between profit, which is the total revenue minus the total costs, and that just gives us a number. And in a way, that number's interesting, great, we made a profit. But if we want to do a bit more of an advanced analysis, we want to calculate profitability. And profitability is a measure of how efficiently a business actually is turning its sales revenue into profit. Okay, how efficient are we at getting from there to there? It's basically, profitability is a measure of how effectively a business is controlling its costs, and therefore how effectively it's able to generate profit from its sales. So I've just simplified the table here. There's the numbers, and we're going to use a formula to see which business is more efficient at actually taking money in and converting it into operating profit. The operating profit margin is a measure of a firm's profitability by looking at the relationship between net profit and sales revenue. Remember, net and operating profit, use it interchangeably. Operating profit, the formula is operating profit divided by sales revenue times 100. So when we put those numbers in, we see that business A, it got in £950,000, and of that £950,000, it converted 100,000 into operating profit. That gives it a net profit margin of 10.5%. Another way of looking at this is for every pound this business took in sales revenue, they converted 10.5 pence into profit. But when we look at business B and put the numbers in, 50 divided by 250,000 times that by 100, we see that business B is almost twice as profitable as business A. They're far more efficient at getting this money that they've taken in sales revenue and turning it into operating profit. For each sale that business B make, for each pound taken in revenue for business B, they are converting 20 pence of that pound into profit at the end of the day. In other words, business B are far more effective at turning revenue into profit. And that's why calculating profitability, although it may look on the surface like business A are a more far bigger company and therefore more profitable, yes, they make more profit in outright terms, but actually in terms of profitability, how efficient a business is, business B is actually almost twice as efficient as business A. So, the higher the figure, the better, and this will, I think dependent is probably the wrong word. So the higher the figure, the better. Why is it useful to do this process? Well, we can compare against past performance. So last year, business B might say, well, we were converting, last year we were converting, 25p in every pound. We had a 25% operating profit margin. This year we're down to 20% profit, operating profit margin. That's not too good. We can compare against our competitors' performance. Well, business B will be saying, well, we're still doing better than business A, so that's not too bad. We can compare against industry averages and then benchmark. So generally what you want to remember is the higher the figure, the better news that is for businesses.